turn to the view of Wall Street this morning. Marvin Barth of Thematic Markets writes, quote, U.S. growth will continue to outpace consensus expectations. The combination of the One Big Beautiful Bill Act and tariffs provide modest stimulus to the economy, even if some fiscal consolidation from tariff revenue this year. Marvin joins us now. He's founder of Thematic Markets and former chief economist for international affairs at the U.S. Treasury. Marvin, so wonderful to see you this morning. And look, given the EU deal on hand, it looks like we'll have something like a 15% tariff, at least on goods coming into the U.S., not to speak of commodity tariffs, which are higher. U.S. markets, both stocks and bonds, are sanguine about it, should they be?
Yeah, I think this is overall a positive thing for the U.S., right? The U.S. is getting a winning position across the board. They effectively cut income taxes and raise revenue elsewhere. And while I know that a lot of people get very disturbed by tariffs, from the applying country in this perspective, they're less negative for growth than income taxes. The math of that, the economic theory of that is all actually very straightforward. And so this is effectively a positive for the U.S. economy. It's not necessarily a positive for Europe, which is why we're seeing this reaction in the euro dollar exchange rate.
Can you get more into that, Marvin? Because the Philips CEO is speaking to Bloomberg earlier this morning saying, hey, we can handle a 15% tariff. We'll be okay with that. Can companies in Europe, can the economy handle a 15% tariff, Marvin?
Oh, yeah, I think most of them can, right? Like, remember that margins are typically higher than that in most advanced companies. For commodities, things like that, obviously that's not the case, but those aren't the things that the U.S. is buying from Europe. Actually, that trade tends to go the other way. So, yeah, they can handle it. And remember, the reason why the U.S. is able to do this with country after country after country is that the U.S., at the end of the day, is responsible for 25% of global demand. And so you kind of have to participate in that market.
Marvin, does that mean when we think about long-term consequences, that there is not a risk that trading partners, that EU, that Japan, that the UK start to move away from the U.S. as both a trading and investment partner?
Well, I think that what you're trying to see, or what you're seeing the Trump administration try to do, rather, is to actually pull those things closer together. So they do see a set of imbalances here, and it's not just the trade imbalances, it is really the set of rules. So, there was a lot of talk about tariffs, but, let's remember the U.S. or the EU has a lot of standards that block all sorts of U.S. imports. That's effectively like a tariff, only it's a 100% tariff. So this does go both ways. And I know that right now the EU is smarting, as are a lot of other U.S. trading partners. But I think as time goes on, these will be seen more in the light of actually this is just a leveling up of the imbalance in trade that the U.S. was facing before in terms of its terms of trade with its trading partners.
Marvin, can you just translate all of this into assets? Does that mean risk on can continue at some pace? Does that mean the threat of inflation or a Fed that's unable to cut, that is somewhat relieved as well?
Yeah, I think all of these things, look, as long as we have a continued growth impulse here, and the U.S. has been the leading economy, so keeping that going has been an important point and is going to keep a positive trend in asset markets. From the inflation perspective, so far, we continue to see that inflation is not coming down below the Fed's target, and inflation expectations are elevated. So they're going to be on the sideline. But I think one of the points that we've talked about many times before, Dani, is that I think that they have the wrong view of where neutral rates are. Neutral rates are actually much higher, which is why the U.S. economy continues to do quite well throughout all of this.
Marvin, I want to talk about one of the risks that you have flagged, and that is stablecoins. You're concerned that it will raise the risk of an unstable monetary regime. What do you mean by that? What is the risk?
Well, actually, it's more about the risk two unstable monetary regimes. So if you have a country like, say, Nigeria, where you have rampant inflation and a lack of faith in the monetary authorities, you have the potential to see stable coins that are now validated by the U.S. government and anybody can use on their phone effectively turn into an alternative source of money, and those existing currency regimes collapse. Where that, that's not just an emerging market issue. Imagine if we had stable coins as they exist now back in 2011 or 2012 during the EMU crisis. You wouldn't have had Spaniards and Italians switching their accounts to Deutsche Bank. You would have had them switching it to US dollars on their phone, and that would have been a very different outcome for that crisis.
All right, Marvin, we're going to have to leave it there. Just a taste of some of your take on stablecoin. An excellent research note you have on that. We'll have to get more into it next time. Marvin Barth of Thematic Markets. Let's now get you some other top